Call 888-653-0124 today or click the link in the description to learn more. Are you looking for a revenue-based business loan? Then you need to hear this. A revenue-based business loan is a type of small business loan that allows borrowers to pay back their loans using their future earnings. This means that they can borrow money to start up their business, grow their business, and then repay the loan when they are making a profit. Getting financing for your business depends on consistent revenue. The key benefit of this type of loan is that it helps businesses grow without having to worry about paying back loans before their revenues increase. Business owners may also qualify for this type of revenue loan if they have a proven track record of generating high levels of monthly sales. This type of loan is ideal for small business owners who want to expand their operations but don't have access to a capital infusion from banks. It allows them to borrow money at competitive rates and pay back the loan once they see profits. Business lenders will usually require some level of proof that your company has generated significant monthly income in the past. Some examples include sales figures that show consistent growth over time, income statements showing steady or increasing profits, tax returns with large deductions, receipts showing consistent customer purchases. You must be able to prove that your business generates substantial amounts of revenue every month. If you cannot provide sufficient evidence of this, then you might not be eligible for a revenue-based business loans. Second, you must show that your business is profitable. You will need to provide documentation about your business operations, such as balance sheets, business bank statements, tax returns, and other documents that show that your business is actually turning a profit. Third, you must be able to make regular payments on the loan. The lender will expect you to keep loan payments current throughout the term of the loan. They will probably request that you submit a payment history so that they know you can afford to repay the loan. Lenders will consider factors like your business credit score and previous loan performance when deciding whether your business model can support a revenue-based loan. However, these are just two of many factors that lenders use to determine eligibility. If you meet all the revenue requirements above, then there is no reason you should not get a revenue-based business loan. In fact, most lenders offer this type of loan because it provides them with a way to finance new startups and growing companies. If your annual future revenue is less than underscore, you may qualify. The amount of money you owe will depend on the terms of your loan agreement. For example, if your loan has fixed interest rates, then the amount of money you pay back every year will be the same regardless of how much money you earn. But if your loan has variable interest rates, then the rate at which you repay your loan will increase as your income increases. Your monthly revenue, along with a solid business plan, can help you find the right loan product for your needs. If your annual revenue is or more than underscore, the interest rate on this type of loan will depend on several factors, including the size of your company, your credit score, and the amount of equity you offer as collateral. Typically, the higher your monthly sales volume, the lower the interest rate. Revenue-based funds are often available through banks, credit unions, and alternative lending institutions. These types of loans are also referred to as growth loans because they allow borrowers to grow their businesses without having to take out additional debt. A revenue-based loan may work best for small businesses looking to expand rapidly. As long as your company makes more than $100,000 per year in annual revenues, you could qualify for this type of loan. However, even if your business is generating less than $100,000 in annual revenues, you may still get a revenue-based loan if you have good credit and strong financial records. Many lenders will look past your low level of annual revenue to see how well you manage your finances. If you want to learn more about how a revenue-based loan works, or if you would like to apply for one today, contact us. We can tell you everything you need to know about getting a revenue-based business loan, and we can walk you step by step through the process. Top revenue loans for small business financing options. The best way to finance a new business is to find a lender that will provide you with a line of credit, which gives you access to cash. These loans are usually available for between $25,000 and $500,000, depending on the size of your company and its financial needs. There are several types of revenue-based business loans available. These include fixed-rate loans. These loans give borrowers a certain amount of money each month for a set period. Once the initial term ends, the borrower will continue making payment amounts until the entire loan is paid off. Adjustable rate loans. These loans allow borrowers to adjust the interest rate up or down after a specific date. This means that the borrower may end up paying more or less, depending on what happens to the market. Typically, adjustable rate loans come with a higher APR, annual percentage rate. Line of credit. With a line of credit, you can borrow a certain amount from your lender without having to close out your existing loan first. Revolving credit facility. A revolving credit facility gives you access to additional funds as needed. Term loan. A term loan comes in various forms. One common form is called a term note. It is like a mortgage where you put down a lump sum of money and receive periodic payments over the course of the loan. Another option is a revolver where you take out multiple loans over the life of the loan. Commercial paper. Commercial paper is a short-term debt instrument issued by banks. It is usually sold at a discount below par value. Can revenue-based financing work? The basic idea behind this type of loan is that if a company generates $1 million in monthly sales, it should be able to afford to pay back $100,000 per month. This means that the interest rate on the loan would be around 10%, or 1/10 of the total amount borrowed. If the company does not repay the loan within the agreed-upon timeframe, the lender will take possession of the collateral and liquidate it to recover the outstanding balance. Having daily sales of $5,000 would mean that the interest expense would only be 5%. The primary advantage of these loans is that they offer flexibility and convenience. Unlike traditional bank loans, there are no fixed repayment terms. Instead, you can choose when to repay the loan and how much to pay each month. You also do not have to make any large upfront payments. This type of loan is ideal for companies that have been operating for some time and have built up a solid customer base. While the concept of debt financing may seem like a simple way to raise sufficient capital, most people don't realize just how complex the process really is. Debt financing requires careful planning and execution, which includes things like determining the appropriate interest rates, structuring the deal, and ensuring that all parties understand what they're getting into. Call 888-653-0124 today or click the link in the description to learn more.